As we transition to our next discussion, we delve into the world of factor investing, an approach that has gained significant traction in the investment landscape. Factor models built on quantitative strategies aim to systematically identify return generating attributes in stocks. But the critical question remains, are these models the holy grail of alpha generation, or are they merely a passing trend? While some believe that factor based investing is the future of active portfolio management, others argue that markets evolve and factors that work today may not necessarily perform tomorrow. So, this session will explore the efficacy, longevity, and adaptability of factor models in delivering sustainable alpha. Now, let's welcome our eminent speakers, each of whom brings a unique approach and a wealth of experience. We have with us Mr. Rishabh Nahar, partner and fund manager at Qode Invest. And he is an accomplished quant fund manager with over 8 years of experience in the equity markets. Since 2016, Mr. Rishabh has been managing funds with a research driven, data centric approach, working alongside a team of quant professionals. Mr. Rishabh also manages capital for prominent family offices in Mumbai, consistently delivering optimized investment performance through innovative quantitative strategies. What a pleasure to have you, Mr. Bora. It is now over to you to moderate this session.
Thank you so much, Aishwarya, and a very warm welcome to all the fellow panelists. Hi, Anirudh. Hi, Sonam, and hi, Rishabh. Looking forward to an insightful conversation and a good understanding of all the things you guys are doing, how we're navigating these markets. So I think the last 2 years has shown all the different colors and sides of the market. So let's just start with quick reflection of what you guys made of these markets, of your strategies. What are the big wins, the big mistakes, the big learnings, the big improvements that you guys made in the last, over the last 2 years? Let's just reflect on that to start with. Rishabh, let's
Um,
hear it from you.
Hi, Siddharth.
Hi.
I think the last 2 years been great, right? 23, 24 has been pretty much a bull market. And I think that, most of the learning has come in the last 45 days. So during bull market, it's pretty much like, you don't need to learn much. You, the last 6 months, in fact, from like, April, May, you buy a stock, it's up. There isn't much, to be done, and everyone's been outperforming the market. But the last 45 days is probably a reality check for a lot of investors, especially on the small and mid cap side. And, like Sonam said back in 2018, right? Like, if you run a back test up until 2018, like 2014 to 17, the kind of, the returns that you were seeing, right? And most like a lot of quant funds started shop in 2018 and 18 to 20 and was like pretty much a lot of pain. And I think the last 45 days has given, the small and mid cap space a little bit of that people now start believing, okay, there is something like drawdown and there's something like risk management and, those kind of things have to come in play. And, so fund managers like us, that's where, I think that's where we need to come in and not only completely rely on the back test, but take a data set driven call that, if you look at small mid cap valuations, right? It's yet above it's 30% above like the 20-year average or 10-year average. So it's, like Anirudh is sitting on, pretty much a large amount of cash. So that's a call that he took. I don't know whether that was a quant call or a discretionary call or, it was a data driven call. But these kind of calls do help investors in times of drawdown. Also, a lot of new money, a lot of new money came in September, August. So the guys who invested September, August, fully invested in, small mid cap have seen a lot of pain. See, guys who entered in 2022, they've already made money. You're seeing drawdowns from, peaks or from profits and other thing. But new investors, starting out. So to manage that pain is wherein, where fund managers like us have to come in and make sure that new investors don't see that pain, because for a lot of these guys, it's a first time bear market, right? A lot of quant funds, it's a first time bear market. So, maybe asset allocation comes into play out there. So I think, it's going to be like fairly good to see how this next 2, 3 months plays out and how managers manage AUM now. Yeah.
So I think the one thing that
You will.
changed in India over the last 3 to 5 years was uh, basically investors' return expectations completely changed, because we saw a phase where 35% became a more normal return expectation, which was very unlike in the past. I think the long term, returns of this asset class is in the 12 to 18% sort of range. But clearly, the last 4 5 years have spoiled the expectation of people, and therefore changed the how the fund managers actually navigate and set the right bar for these investors. So I think this reality check was quite needed. Seeing the other side of equities is also important. And yeah, I hear what you said about the whole 2018-19 experience. So basically, even we've tested multiple different quant strategies, and almost none actually outperform in the 2018-19 cycle. I think that was a period where factor strategies didn't really do so well. So I think historically also there are many years where active strategies have done well, some years where passive strategies have done well, and many more years where factor strategies or multi-factor approaches have done well. So I would just like to, understand each one of yours perspective on this, that based on all the research you guys have done, based on your live market experience, based on the back tests you guys have run, when have you seen the quant edge really play out in the market? And when have you seen it really fail in the market? Because I'm sure there are both phases to every strategy. Because if quant was the holy grail alone, like only one strategy performs every time, that would be an unrealistic expectation. So let's understand from you guys, when did you see the quant edge play out, and when did the quant edge sort of fail you as well?
So, I think, so that the way we look at quant is like, I mean, we like to think in terms of first principles, right? I think quant is just a tool. So when we discuss internally, right? Ultimately, like if there's EPS growth and the business will do well, that's what you want to get to. You want to strip down to the basics. So we are not looking at quant as a black box or a tool that will throw out some magic formula, or it'll throw out a stock and that stock is going to outperform. I think so. The way we are looking at it is that can we work backwards? Like, what kind of businesses do you want to own? And, just like Anirudh mentioned earlier, right? Like what you've learned over the years, you want to implement that in the form of data. So, that's the idea with quant. So I don't think so, like, whether you want to term it quant, whether you want to term it data driven, I don't think that is as significant as if you want to strip it down to the basics, right? What kind of business do you want to own? Where are the markets placed today? What kind of position size you want to buy? So, that's the camp that I belong to. So I think so, like, the different quant. So the earlier back in the day, like 2016, I would run back tests and, leave my brains on the side thinking that, okay, this back test has done well, so this will continue to do well, right? But, it wasn't like I wasn't thinking ahead of that. But over the years, what we've realized is that, can we strip down to the basics? Why did the back test do well? What kind of businesses do you own? What kind of cycles do you go through? What businesses do well? Like, growth has done phenomenally 2022 to 24. 2018 to 20, like, everyone's back tested hasn't done as well. But ultimately, you want to see that, like, we are in this for 5 10 years. The moment, your time horizon extends, it becomes a lot easier. If you're looking at 1 month, 2 month, 1 year, it's anybody's guess, right? We don't know if the yesterday was the bottom or yesterday was just the start of a bear market. So, I think quant, again, like we look at it just as a tool, and I don't think so. It is, like it's the answer to, yeah.
Fair. I think we've got another, I would say, another 15 20 minutes, and we have quite a few topics to, sort of touch upon. I'm going to, briefly talk about some of the critical questions which I think, all the viewers, participants, and investors might be interested in understanding. Since we are in the whole phase of, market correction, and it's all about, risk right now and volatility and drawdowns, let's take up a couple of risk-oriented questions before we move into the other aspects of each strategy. What are you, doing in your strategy in terms of, managing risk, going to cash, hedging with options, buying gold, using stop losses, which are either sector specific or stock specific? Why don't you, take us through the insights on your model that you're following in terms of managing risk?
Yeah, so I think, Siddharth, like there are a couple of things in this. So from April, May, I mean, maybe June onwards, whatever new AUM that we received was pretty much divided. Almost 40 50% of that went into gold as a hedge. Now, like Sonam mentioned, right, there is, if if you're running a mid and small cap portfolio, it's very hard to hedge yourself using options. So we actively do, hedge our portfolios all through November, December, Jan, Feb. So on the larger cap, like it really, on the large cap portfolios, you would not see any kind of drawdown. So staying invested would be very easy with a large cap portfolio and then hedging it using options. Your question earlier, Siddharth, to Anirudh, I think was, would you want to hold on to that hedge for the entire 6 months or a year, I think that would be really costly. Like if you would open a December hedge, could cost you like 5, 6 kind of a
Yeah, so it
percent.
was permanent hedge or time your hedge in
So
terms
you
of.
have to time your hedge. Permanent hedge is just going to bleed because markets, I mean, over a 3, 4 year period, it's, markets are going to be positive, right? So permanent hedge is just going to be really costly. So you'll have to time your hedge. And for that, you'd have to have a model in place. So that's where quant would come into play and the picture out there to subjectively time the market could be, again, really hard, anybody's guess. Now, the second thing is that I think so shifting sectors is really hard because when a bear market, like Anirudh mentioned, like 2008, right, there was no sector that was not down. So cash was your only call then, or another asset. If you want a straight line equity curve, then if you're trying to achieve like really crazy risk adjusted returns, then you would have to have an all weather portfolio, have multiple uncorrelated asset classes, which over a 5, 10 year period would perform. But unfortunately, in India, we have very few asset classes that we could diversify within.
So, what is your whole perspective on factor investing? Do you use a single factor model, multi-factor model? Do you use multi-model strategies? How do you approach factor investing? Are you using traditional factors like quality, value, growth, momentum, volatility, or have you expanded your factor set beyond just the traditional factors which have literature proof? So let's just understand your perspective on factor investing.
Sure, Siddharth. So, just to break it down again in terms of first principles, right? Like, what do you want to buy, when do you want to buy it, and how much do you want to buy? So, what to buy is wherein like the multi-factor model comes into play, right? So, you could use like we are using say ROC, ROEs, debt to equity, all sort of fundamental factors. Then, when do you want to buy? When valuation comes into picture, how much is where that's the tricky part, right? So with quant, like I mentioned this earlier also on another discussion, it's hard to get to a 10, 12 stock portfolio using a quant model. If you're using a quant model, 30 stock, 35 stock kind of a portfolio, is pretty easy. But the moment, you're going to a 10, 15 stock, because the way we look at it is that quant works on the law of averages, right? And
Probabilities.
and those averages, you could really outperform with a 10 stock portfolio, or you could. So if you want to move to a more concentrated portfolio, then probably some sort of fundamental analysis and, the quantum mental process will come into play. In terms of market timing, I think so macroeconomic factors is a key component out there, especially like, for example, like this September, we were pretty much on 50 to 55%, gold. So through this fall, that really, it just cushioned the entire portfolio as a whole, and the entire model shifted to a more low wall, large cap portfolio from a mid and small cap. So I don't think it's just one factor; it has to be multiple factors because the market is a complicated place. And like you mentioned earlier, I don't think so. You can just leave the model. It's a constant learning process. So we like to stick like we love quant because it makes us disciplined. The entire approach makes us really strict and disciplined, and following rules becomes a lot easier, at least for me, individually. So yeah, I mean, so it's pretty much it's a diverse thing. So I don't think so, it's a one factor back test and it ends out there.
Fair enough. Fair enough. So guys, just to end on a high note, I think based on all the research I've done and all the things that my models are showing up, we are basically getting signals that markets are closer to mid-cycle troughs. So here on, the recovery does look very sharp across some pockets of the market, where value has emerged, where extreme panic selling has happened, alpha compression has happened across multiple pockets of the market. So, the recovery can be equally good and sharp. Why don't, we get a quick minute from each one of you of the improvements that y'all have made, the big changes that you all have made based on the recent learnings, so that the next phase in the market, whether it's a bull market, a sideways market, is much better for all our investors.
I think there's no one size fits all in the market, and especially when if you're managing your own money, it's a different ball game altogether. When you're managing, money for an investor, it's very different, right? So understanding what your investor is like, I mean, momentum in 2024, maybe August was very different from momentum today, right? So when you're showing a momentum fund to an investor in August, he's pretty much like, yeah, I want to do this because this is 40% per annum. And, today he's not ready to see what the reality is. It's not that momentum hasn't seen this, right? I mean, it's pretty basic. You go through 20 years and you see that this happens very often. So, explaining to the investor and understanding yourself that you think that this investor is even ready for this, and that match, right? Making sure that
Yeah.
matching his nature to what kind of strategy you're running is, I think, is a key component.
Fair enough. Fair
Yeah.
enough. I think we've run out of time. Had at least 1 more hour of discussion left with all you guys, but I think we'll do it offline on another day. But thank you so much, guys, for all the valuable insights, live experiences, being so honest and transparent with everyone. And I hope all the participants have taken a lot of good inputs from all the discussion we've had. And I think the key thing to understand is that factor investing as an approach will continue to drive alpha. It's just that the factors will keep evolving. We cannot restrict ourselves to just 4, 5, or 6 factors, or just momentum as a critical factor, which a lot of people confuse quant investing with momentum investing. I think quant is much broader. Quant has the ability to become a value oriented fund, a growth oriented fund, a dividend oriented fund, a vol oriented fund based on the market cycle it operates. And I think with more data sets becoming available to all fund managers and Indian capital market players, I think the sort of factors that we'll be able to create and manage will also sort of evolve, and it'll give a differentiated edge to a lot of investors. Finally, it's all about managing risk in a bad market, and there are 10 different ways of managing risk. And in the bull market, I think the narrative for everybody is same: chase returns, chase growth, chase momentum, and capture as much on the upside as you can. uh, the first time investors are first seeing a crash of such a level in the last 3 4 years. So I think it is important to see this, to understand the asset class for what it actually is. It can't continuously give you 40, 50, 60% returns every year. That's not a realistic scenario whatsoever. So I think this correction gives you two things: one, a learning, and second, an opportunity to top up. So I think with that, let's sort of conclude this remark.